Welcome back to The Explainer. Today, we're diving into what I like to call the ultimate trading masterclass. Now, if you've ever stared at a stock, Forex, or crypto chart, you've probably felt like you're just looking at a chaotic mess of random, zigzagging lines. It can be super overwhelming, even if you know the basics. But what if I told you those lines aren't random at all? They're actually incredibly accurate visual maps of human psychology. Today, we're demystifying the absolute core foundation of price action, support and resistance. By the end of this explainer, you're going to see the markets in a completely new, structured way.
Okay, let's jump right into this. I want you to imagine taking a heavy rubber ball and just throwing it as hard as you can at the floor. What happens? It bounces up, hits the ceiling of the room, and then bounces right back down. It's dynamic, but it's completely trapped between those two physical barriers. Believe it or not, this is exactly how price action works in the financial markets. The price basically bounces between a predefined floor, which we call support, and a ceiling, which we call resistance.
Let's put these two opposing forces head to head. On one side, we have support. Think of this as your physical floor. This is the zone where the buyers hang out. When the price drops down to this floor, buyers step in, creating massive economic demand, which literally catches the falling price. Now, on the exact opposite side, we've got resistance. This is your ceiling. This is seller territory. When the price rises up to this level, sellers flood the market with supply, they cap the price, and push it right back down. It's just a constant, relentless tug of war between demand and supply.
All right, let's move into Section 1, the psychology of price.
See, it's so important to realize that when we're in the market, we aren't just trading against a machine or some cold algorithm. We're trading against raw human emotion. The floor and the ceiling on your charts, they're built entirely out of collective human fear and human greed. Take a look at how this emotional cycle plays out perfectly with a familiar asset like gold. Step 1. Gold drops to a low of $25,000. Step 2. Buyers see this massive discount, greed kicks in, and they rush to buy. That sheer volume of demand creates a rock-solid floor. Step 3. That aggressive rush shoots the price all the way up to $70,000. But then, look at Step 4. The folks who bought at $25K look at their massive open profits and they decide to cash out while they're ahead. They instantly become sellers, flood the market with supply, and boom, they've just built a ceiling of resistance.
To really ground this concept, think about the real estate market. Imagine you live in a really nice neighborhood where every single house is valued at 1 crore. Suddenly, one neighbor gets spooked about the economy and panic sells their house for just 80 lakhs. The second a potential buyer sees they can get that exact same house for 80 lakhs, the ceiling for your house instantly drops. That sudden supply of cheaper options completely kills the demand for your 1 crore asking price. In financial trading, that exact same panic or sudden profit-taking instantly builds that invisible ceiling of resistance right there on your stock chart.
Which brings us to Section 2, breakouts and role reversals.
Because, let's face it, a floor and a ceiling won't hold up forever. So we have to ask a pretty critical question here. What exactly happens when the market ceiling completely shatters? When buyers are so greedy and so absolutely convinced the price is going higher that they smash right through the seller's resistance. This is where the real battlefield lies. It's the ultimate conflict between a genuine shift in market value and a calculated trap set by massive banking institutions.
And this right here is the critical difference every single trader has to learn to spot. Over on the left, we've got a true breakout. The price fiercely breaks the ceiling, manages to sustain itself up there, and genuinely creates a new, higher trend. But on the right, that's the dreaded fake out. This is when the price just briefly pokes its head through the ceiling or floor, deliberately tricking amateur retail traders into buying in before violently snapping back in the opposite direction. Massive institutions, the smart money, use these fakeouts as a liquidity sweep just to trigger your stop losses. They literally need your losing orders to fuel their massive trades.
But when a true breakout does happen, something incredible occurs on the chart. We get a role reversal. Imagine a stock breaks its heavy resistance ceiling at $30 and blasts upward. Now, if that price eventually starts to fall back down to catch its breath, that old $30 ceiling doesn't act as a ceiling anymore. It naturally transforms into the bouncing ball's brand new floor. Old resistance 1 permanently becomes your new support 1. The old secondary resistance above it, that becomes the new primary ceiling. The entire market essentially shifts its psychology up 1 floor in the building.
Okay, let's get practical with Section 3, 5 rules for drawing zones.
Now that we've got the psychology and mechanics down, it's time to grab your charting tools. Here are your 5 golden rules to accurately mark up your charts rather than just guessing. Rule number 1 is an absolute game changer. Stop using thin horizontal lines.
From now on, you draw rectangles because support and resistance are living, breathing zones. Second, you want to look for areas where the price has touched multiple times. Third, identify strong, violent reversals. Fourth, always keep an eye out for those roll reversals we just talked about. And fifth, keep your zones relevant to the current price. There's no need to clutter your chart with irrelevant data from 5 years ago.
Let's zoom in on Rule 1 for a second, because honestly, this is where 90% of beginners get wrecked and lose their capital. They'll draw a single thin pencil line at exactly $50.00 and fully expect the massive, chaotic market to bounce perfectly off that one specific penny. But big banks and institutions don't buy at a single cent. They acquire their massive positions across a range, maybe anywhere between 49.80 and 50.20. If you only draw a single line, you're going to constantly get faked out by normal market noise. Always use your rectangle tool to mark the entire battlefield zone.
Let's also take a closer look at Rule 3. You really want to train your eyes to scan the chart for swing highs and swing lows. These are specific spots where the price sharply and violently reverses direction, creating this distinct, sharp V shape on the chart. A lot of times you'll see a massive wick on the candle right in these spots. That V shape is basically a giant neon sign telling you exactly where massive institutional buy or sell orders are just sitting in wait. When the price gets back to that V shape, you can expect an absolute war between the buyers and sellers.
Moving right along to Section 4, using pivot point indicators.
Now, drawing manually is a vital skill, but here's the ultimate shortcut for you if you want to automate your zone drawing using pure, proven mathematical data. Almost every trading platform out there offers a free tool called the Pivot Point Standard Indicator. When you flip this on, it automatically calculates and plots these essential battlefield lines directly onto your chart for you. You'll get a P line right in the middle, that's your central pivot, your baseline. Below that, it plots S1 and S2, your primary and secondary floors, and above it, R1 and R2, your primary and secondary ceilings. It literally maps out the market structure for you.
Here's my professional traders swear by pivot points. It gives you a massive quantitative edge. Most indicators out there, like moving averages or the RSI, they just lag behind the price. They only tell you what has already happened. Pivot points are fundamentally different. They take the previous day's high, low, and close data to actually predict the future. They map out the exact zones of conflict for today before the market even reaches them. You're literally mapping the traps and the opportunities before the trading day even gets going.
Finally, Section 5, risk management and the ultimate payoff.
We've covered the psychology, the drawing rules, and the automated tools. But the single true purpose behind identifying all these zones? Capital survival. So here is your highly structured, step-by-step master plan. Step 1. Identify if the price is approaching a support or resistance zone, like your S1 or R1 level. Step 2. Never just jump in blindly. Wait for a confirmation candle, a strong visual sign that the market is actually respecting and reversing off that zone. Step 3. Enter your trade. Step 4. And listen, this is the absolute most critical part of your survival. Place your stop loss safely outside that zone rectangle. Because your stop loss is tucked securely just behind the zone, your risk is tiny compared to your potential reward. And finally, Step 5. Target the next logical pivot level to take your profit.
Which brings us to our final thought for this explainer. I want you to ask yourself, in the end, are you trying to predict the future or are you just managing your risk between the market zones? See, the amateurs are out there constantly gambling, stressing out, trying to guess where the price will miraculously go next. The professionals, they just calmly identify the floor, they identify the ceiling, and they expertly manage their risk in the space between. Master these zones, and you stop gambling, you start trading. Thanks so much for joining me for this explainer. I hope it brings some incredible clarity to your charts, and I'll see you in the next